All right, welcome back everyone to KZN Training. And today in economics, we're going to be discussing the Reserve Bank and the different measures it takes to control the economy. We're going to be looking at economic control outside of the Reserve Bank as well. So, looking at things like government's exploration and how they control the economy. In terms of what to expect from today, so I'm going to give you a couple of definitions that I want you guys to understand. It's not going to be a particularly long video, despite the fact that it's 10 topics deep. So we're going to go through some definitions. I'm going to explain to you what the Reserve Bank is. We're going to talk about why it was created. We're going to look at the US system of the Reserve Bank. We're going to look at the South African Reserve Bank. And then, of course, the measures it uses to control the economy. Then, lastly, we're going to have a short discussion about fiscal policy before we leave. And I know that you guys are already thinking, where's the discussion about inflation, hyperinflation, deflation? We're going to have that conversation in the next video. I may touch on it a little bit here as well. But yes, let's get into the definitions that we need to cover. So the first thing we're going to need to understand is what a government security is. So I'm going to read the screen, then I'm going to try to simplify it for you. So a government security, also known as government bonds or treasuries, are debt instruments issued by a government to raise funds. These securities represent a form of borrowing where the government essentially borrows money from investors in exchange for the promise to pay back the principal amount along with periodic interest payments over a specific period. Government securities are considered low-risk investments because they are backed by the government's ability to generate taxes. If you don't already know at present what government securities are, based on what I've just read, so essentially it is, and I want you to think of it as simply as this, even though there's a lot more complexities to it. It's essentially a loan by the government. So the government asks the private sector or individuals in the private sector for a loan. And that loan is low risk because the government always takes taxes and they can probably pay it back. They don't just pay back the principal amount, they pay back the principal amount along with interests. So for the purposes of discussions, I want you guys to understand the government security as that. Then a mortgage-based security. We will consider to think of securities like a loan, right? A mortgage-based security is the same conversation as a loan, but this time around, the system that's used to pay it back is the collective mortgages of multiple people. So let's read what the definition says. Mortgage-based securities are financial instruments that represent an ownership interest in a pool of mortgage loans. These loans are typically bundled together, and the cash flow from the underlying mortgages is used to create securities that can be bought and sold in a financial market. MBS are often issued by are issued and guaranteed by government-sponsored enterprises like Fannie Mae and Freddie Mac or by private institutions. They are a way of providing liquidity to the mortgage market by allowing financial institutions to sell mortgage loans to investors. So essentially, we're going to think about it as a loan system where the system to pay back the loan is via a bunch of mortgages. So the mortgages are the security for the loan. That's a mortgage-based security. Then we're going to look at two terms, and these terms are not going to feature at all in the presentation, but it's important that you understand what they mean and how they operate in order for you to understand the concept of the presentation. So the first one is fractional reserve banking, and the second one is full reserve banking. So not going to read the whole thing. You guys can read what it means, and then you can come back and reach your own conclusions. But basically what fractional reserve banking is the idea that when you take your money to the bank, they don't save all of that money. When your account says that you have 1,000, you've deposited 1,000 rands, they don't really have that entire 1,000 that you've given them. Generally speaking, they'll take a small percentage of that and they will reserve it. So realistically, they will only take a small amount and you'll have access to that. The rest of that money is money that they lend out to other people. So they give other people loans, and in exchange for giving them loans, they get an interest on those loans. So they make that money by being able to use your money to get more money from people via generating interests from those loans. So fractional reserve banking means you deposit an amount, they take a fraction of that amount, they put it into an account. The rest of the amount is used by the bank either as loans or for other financial activities that are intended to grow the amount of money that the bank has. Then there is full reserve banking. Full reserve banking is when banks take the entire amount that you've invested with them and they just reserve it. But you have to pay a specific amount for them to reserve the money for you. This specific amount is how the bank would then make their money. It's a much more conservative approach. Very few banks use this method of banking. So that's the difference between the two. We're going to have a conversation a bit later about how these systems come into play. Now let's talk about what a reserve bank is, or otherwise referred to as a central bank. So a central bank, also known as a reserve bank in some countries, is a financial institution that has a primary role in overseeing the monetary system and implementing monetary policy for a country and a group of countries. Central banks play a crucial role in maintaining economic stability, controlling inflation, and fostering sustainable economic growth. So, and again, when you come back to this page, after you've gone over the whole definition, a lot of things are going to make more sense to you. What monetary policy is going to make a lot more sense to you. What the Reserve Bank and the role that it plays in economic stability is going to make a lot of sense to you. But right now, what I want you to think of the Reserve Bank or central banks is that it is the bank of banks. It is the main bank that distributes money, that controls the economy, and that is basically in charge of making sure that money is going well in the country. We're going to look at its functions in a second, and we're going to look at tools as to how it does this. And yes, for no particular reason, there's a bunch of Dragon Ball Z imagery interwoven into money and the Reserve Bank in this presentation. I don't know whose fault it is. Whoever it is, you should punish them dearly. So let's look at the functions of the Reserve Bank here. So the first one is with respect to monetary policy. Monetary policy is basically, and we'll go over this in detail as well, but it's basically when the Reserve Bank creates a set of policies to monitor the economy and make sure that the economy is staying afloat. So monetary policy, I want you to think of it as the systems that the Reserve Bank uses in order to manage the economy of a particular country. Then the second function is currency issuance. So prior to the existence of central banks and the Reserve Bank, there were a bunch of private banks that used to issue their own notes, and there'd be a lot of inconsistency thereof. So this time around, when there's a central bank, it's the bank that issues the currency and kind of works on what the universal value of what that currency is, as opposed to different banks operating on their own ideas and own notions. Then the third role is that it plays the role of the banker to the government. So in the same way that you have your bank, I don't know, you're on Capitec, FNB, whatever, that is your banker. The government's banker is the Reserve Bank, right? And then the fourth purpose that it plays is that it's the banker of commercial banks. So the central bank lends money to commercial banks. It issues commercial banks. Your commercial banks are your FNBs, Capitecs, all of those guys that you bank with. Those are your commercial banks. You know who they bank with? They bank with the central bank. So that's essentially another role that the Reserve Bank plays. And then the fourth one is financial stability. So this is where central banks, they monitor and they promote the stability of the financial system, which I think to some degree we've already spoken about. Another really important thing that I want you guys to think about here is that in each country, well, should be, but most countries, the central bank is meant to operate independently from political structures. So in South Africa, the SARB, which is the South African Reserve Bank, is an independent institution that is not at all reliant on the politics of the government, and it shouldn't have any government officials that mingle in it, essentially. But we're going to have a slight conversation through just little bits of shade as to why that's not always true and why that's not always the case. So let's get into why the Reserve Bank was created. Firstly, it's the issuing of currency and the standardization so that many private banks that are out there are not issuing their own notes and people are not operating under their own guises. There's a centralized system of issuing money and there's a centralized valuation of a currency, right? Secondly, it's financial stability, which we've already spoken about when we look at the various roles. Thirdly, is that it's a lender of last resorts. So what we mean by this is that when the banks, your commercial banks are experiencing an issue, or if they're down and out, they're down bad, the government's not doing anything, nothing's happening, the Reserve Bank is the last resort where they will lend that bank money to make sure that the economy doesn't tank or to make sure that crucial economic players don't just break down. Because remember, the Reserve Bank is interested in maintaining the quality of the economy. Fourthly, it's through things that we've already spoken about, which is monetary policy, which means the actions that the Reserve Bank takes in order to make sure that the economy remains at a good place, and as well as economic stability, which both are otherwise the same thing. Those were the reasons why it was created. More of them. Firstly, it was to finance the government, which we've already spoken about it because it's the bank of the government essentially. Secondly, it was to control inflation, again, which we'll discuss a bit later, but it's to control the rates of inflation, because the one thing we don't want is hyperinflation. That is when essentially everything becomes valueless. I want you to think of it like that for now until we discuss exactly what hyperinflation means and what it looks like. The third one is foreign exchange and management. So here, central banks may be responsible for managing the country's foreign exchange reserves and intervening in currency markets to stabilize the nation's currency's value. So the scope of work for the Reserve Bank is not only in maintaining domestic economic activity, but also international intervention if necessary to make sure that the currency is operating at the level it should be operating at. Then the fourth one is independence from political pressures, which we've already discussed, right? To say that we don't want them to be influenced by the politics of the nation and the economic approach that particular political parties want to take, because often those are very short-sighted and they're dependent on their own incentives as opposed to the long-term benefit of the country. Cool. Now we're going to do a bit of exploration with respect to the US Federal Reserve Bank and how it was created. So in the Panic of 1907, also known as the Bankers' Panic, was a severe financial crisis that highlighted the weaknesses in the US's banking system. The panic was characterized by bank runs, a sharp stock market decline, and a lack of effective response to the existing banking structure. The crisis underscored the need for a more centralized and responsive system to manage financial panics. Let's look at what this financial panic actually was, right? So, during the time, one of the banks essentially fell. And by fell, I mean it was no longer operational and it failed, because a bank is a business, right? Sometimes businesses fail, particularly business that do probability-based banking, which is what all of your banks do, if we're being honest. But yeah, businesses fail sometimes when they're in that space. So that is what underscored that panic. One of the banks essentially failed. And because people saw that this one bank failed, everyone was rushing to withdraw their money that they had in reserves. Now, remember, we spoke earlier about the fact that banks use fractional reserve banking, which means that if you put in $1 billion, you don't actually have $1 billion in your account. Most of it probably went to someone else or some other people. So if everyone were to rush and withdraw from the banks at once, and if that's what people want to do, then that's going to be a problem for the bank, because the bank doesn't really have all of that money. So because of that panic, most of the banks were faltering. What was the response to that? An unnecessarily wealthy individual by the name of JP Morgan was able to lend out some money to the banks so that they had more reserves and that they could pay out people. So that was meant to fix the problem. And see, the issue with this is that In order for it to work, it relies on very wealthy people being invested to do things like this. And it concentrates power in the incredibly wealthy group in society. So people came together and they realized, no, we need a more centralized system that is going to help us when we are in conditions and situations like this, as opposed to relying on wealthy financiers. So that is what led to the Federal Reserve Act of 1913. That established the Federal Reserve System as the central banking authority of the United States. It created a decentralized system of regional banks overseen by a central board of governors to provide a more flexible and responsive approach to monetary policy. Basically, the Federal Reserve Act was like, we need a reserve bank in order to make sure that we're not continuously experiencing the problems here. In short, that's basically what it is. Look at how the US Federal Reserve Bank operates, as well as its just general structure. So the US Federal Reserve Bank has Congress, which oversees the federal systems, its entities, and makes sure that it's working fine, which is why like the entire idea of a central bank or a Federal Reserve Bank without political involvement is not necessarily as true as people make it out to be, particularly because some members of this federal system are elected by the government, by the president. So not entirely a system that is devoid of politics. But, oh well. So it consists of Congress, which oversees the entire system. And then there's the Federal Open Market Committee, otherwise known as FOMC. And the FOMC is the body that is responsible for making decisions about monetary policy in the United States. It includes the 7 members of the Board of Governors and the president of the 12 Federal Reserve Banks. Because remember, America doesn't just have one central reserve bank. It has a bunch of Federal Reserve Banks that are distributed across the country. And then there's a central board of governors that's meant to govern over all of the different reserve banks that are in the different states. And then the FOMC meets regularly to assess economic conditions and determine the appropriate monetary policy stance. Other than that, there's also the Board of Governors. Now, the Board of Governors is the main governing body for the Federal Reserve System. It's located in Washington, D.C., and consists of 7 members appointed by the President of the United States, which is a conversation we were just having, and it's confirmed by the Senate, right? So governors serve a staggered 14-year term, which is insane, to ensure continuity and independence. The chairman and vice chairman of the board are appointed from among sitting governors and serve a 4-year term. That's basically how the Board of Governors operates. Then there is the Federal Reserve Bank. So the Federal Reserve Bank is divided into 12 regional banks, and each serves a specific district. These Federal Reserve Banks are located in major cities across the United States, including New York, San Francisco, Chicago, and a bunch of other cities. And each regional bank is responsible for carrying out the Federal Reserve's functions within its districts, such as conducting monetary policy, supervising and regulating the banks, and providing financial services to depository institutions. And there are other smaller councils as well, such as the Advisory Council. There's the Federal Advisory Council, which comprises of representatives from each of the 12 Federal Reserve districts. And the FSC meets, I think, 4 times a year. Then there's the Consumer Advisory Council. This council advises the board on issues related to consumer financial services. And then I think there's also the Community Depository Institutions Advisory Council that represents the interest of smaller financial institutions and provides input on their economic conditions. Oh, also let's not forget the member banks. So national banks and state chartered banks that choose to become members of the Federal Reserve System are also known as member banks. And the member banks hold stocks in their respective regions in the Federal Reserve System, essentially. And they elect 6 of the 9 members of each regional bank's board of directors. So member banks receive certain benefits such as access to Federal Reserve services and influences over the governance of the regional banks. So that's basically the structure and how it operates. but you don't need all of the details I just gave you. Like if you just understand what's going on in this diagram, then I think you should otherwise be perfectly fine. Then, if we want to look at the South African Reserve Bank, so it has a slightly different structure. So there is a board of directors. It's governed by a board of directors, which is responsible for the management and administration of the bank. Then there is the governor, which is the highest ranking official, and it's responsible for the direction and management of the bank. There are a bunch of deputy governors as well. And then there's also the Monetary Policy Committee. There's also the Prudential Authority, as well as the Financial Stability Committee and the Currency Management. So you guys can go through what each of these are and what they stand for. I don't think it's too complex to understand. Cool. And then we want to have a conversation, and this is where I think it becomes more contentious and more debate orientated, which is the idea of how does the Fed control the economy. So the first one is through discount rates. So essentially what discount rates are is the rate at which the Reserve Bank lends money to commercial banks, right? So the interest rate that the Reserve Bank will apply on the money that they give to commercial bank is what we refer to as the discount rate. So it could either increase the discount rate, and obviously if it's giving or if it's lending money to reserve banks at an increased rate, if the Reserve Bank is lending money to commercial banks at an increased rate, that obviously means that the interest that banks are going to charge is going to be higher. Similarly, if they are lowering the amount of if they are lowering their discount rate, then that means lower interest rates that the bank is going to charge for consumer loans. So that's that. And then the second one is reserve requirements. So reserve requirements refer to, remember when we were speaking about full reserve banking and fractional reserve banking. So the fraction that the bank needs to reserve is often determined by the Federal Reserve Bank. So if it wants to increase the reserve requirements to say that you should maybe save 20 to 30% of what you are being given by the person, then it can do that. So it can change the reserve requirement, and we're going to look at the conditions and the reasons why it either increases it or decreases it. The third one is that it pays a interest rate on the excess reserves that banks keep. So the excess, there's the reserve requirement, which is the minimum that banks need to keep. Then if banks decide to keep extra, or the excess reserves that they keep, there's an interest that's paid by the Fed based on that. And then by adjusting the interest rate on excess reserves, the Fed can influence the incentive for banks to either lend or hold more reserves. And obviously we can look into why we'd want to do either of those things. Then there's forward guidance. This is where the Reserve Bank essentially communicates its policy and what it wants to do with the commercial banks and the rest of the players, so that they are aware of how they are meant to operate as well, to make sure that they're in line with the policies of the Reserve Bank. Then there's managing inflation and employment. So the Fed has a dual mandate of achieving maximum sustainable employment and stable prices. And it aims to keep inflation at a target rate and make adjustments to monetary policy to foster employment and economic growth. Remember, inflation isn't always a bad thing, right? The one thing we hate is hyperinflation, because it means that our currency ultimately becomes valueless to some regards. When hyperinflation reaches a horrible place, let's say that. So these are a few ways that the Federal Reserve controls the economy. We're going to look at two other ways really soon. We're going to look at open market operations, and we're also going to look at quantitative easing, sorry. All right, open market operations refer to the buying and selling of government securities by a central bank in the open market. Remember, we already spoke about what government securities are. They are loans that are backed up by taxes, right? So it's the government saying, we want a loan, but we're going to pay it back via taxes. That's what a government security is. So the primary objective of an open market operation is to influence the supply of money, interest rates, and credit conditions in the economy, right? So you can either buy securities. When they buy securities, that's when the central bank buys the government security in the open market. So this is injecting money into the system. Basically, I think the simple way I want to explain it is that the government puts out a hit. They're like, hey, we need a loan. So that is a government-based security. The Federal Reserve is now going to buy that. By buy that, we mean they're going to give that loan. And then after giving that loan, they're injecting money into the economy by giving them that loan. And then the government would have to pay it back later with an interest rate, of course. Where are they getting this money that they're injecting into the loan? Sometimes they are very much just creating it. They are pulling it from an invisible place to give. So yes, that's a real thing. Yeah, then selling securities is when the central bank sells government securities. So the securities, the IOUs from the government, it takes them and it sells them to the private sector. It says, hey, you guys can give this money. So when it sells these securities, that's meant to decrease the amount of money in circulation. It's usually used to curb inflation in some cases. All right, then we can discuss how it impacts interest rates. So the buying and selling of securities affects the supply and demand of money in the financial system, which is something that we already spoke about, right? So obviously, the more money that is available, the increase the supply of money, then obviously that'll affect the interest rates in which people will be buying and selling for. There's a decrease if there's a decrease in the amount of money, that will also affect the interest rates. So when the central bank buys securities, it increases the supply of money and puts a downward pressure on short-term interest rates, right? So when it's putting money into the economy, that is decreasing the interest rate. Conversely, when it sells securities, it reduces the supply of money, and this leads to an upward pressure on interest rates. So when it buys securities, there's an increase in the interest rate, right? Then it also influences economic activities. It's very intuitive because remember, we just spoke about how it influences interest rates, and interest rates increase the amount of lending that happens in the economy. When people are able to get loans, then people are able to buy more things. When people pay back those loans again, it's circulation of money in the economy. So interest rates are very valuable towards that entire process. And they are instrumental in implementing monetary policy. So the way that they're instrumental in implementing monetary policy is that it's not just the government, it's not just the central bank saying, hey, we're gonna change our discount rates in hopes that it'll have the impact that we want. No, they are strategically and directly buying government securities that will yield the kind of impact that they want. So they are participating in the economy that they want to change, which is very valuable for monetary policy. So let's look at some advantages. So firstly, it's more precise in creating its monetary policy. We've already discussed that. And then there's greater flexibility. So because it's participating in the economy by buying these, by buying these government securities, then it's able to adjust and be flexible in real time because it is the act that is directly participating in the process as opposed to being passive, like when it changes discount rates, right? And then, of course, market signal, you can also read up what that's about because it's able to clearly communicate its intentions in the economy through the stocks that it buys. So economic players are able to understand the reasons around it, and they're also able to adjust in order to make sure that they are cooperating with the monetary policy of the Reserve Bank. Disadvantages is potential for market distortions. So persistently buying government securities can reduce the amount that they yield, which would affect market pricing. Then we can chat about market dependency as well. So in cases like this, right, if the market is under a lot of stress, open market policies may have a limited impact if the market participants have a strong preferability towards liquidity. So that is to say, if people simply are not complying with the open market operations, that won't change the problems that exist. So open market operations may not always be effective in creating the impact that they want, and also they can have a otherwise negative or positive impact on the exchange rates, depending on the scale at which they're implemented as well. All right, now we're going to discuss quantitative easing, which should be easy to understand based on the things that we've already discussed. So quantitative easing is a monetary policy tool that is used by central banks to stimulate the economy when lowering interest rates and everything else has been ineffective. So quantitative easing involves central banks buying financial assets. So these are government securities, like we spoke about, but sometimes mortgage-backed securities as well, or any securities that are available in the open market, essentially. So with the aim of increasing the supply of money and lowering long-term interest rates by encouraging borrowing and spending. So what do we mean by this? So you put out an IOU there, which is what we said a security is for now, right? You put it out there. And what happens after that is the Reserve Bank buys that IOU. By buying it, I mean they finance it. They give you that money. Where are they getting that money from? Absolutely nowhere sometimes. They are literally pulling that money from an invisible place and pumping it into the economy. Remember, they are the guys that print money and put it out. If they want to do that, then they can. So the purpose of this is to increase the amount of money or increase the monetary flow within the country at that time. So that's why they would implement this process of quantitative easing. Or you can call it QE if you don't want to keep saying it the way I'm saying it. So it in the long term, it lowers the interest rates because remember, when we have more money in our economy, the interest rate is lower. When we have less money in our economy, the interest rate is higher. So QE pumps money into the economy, lowers our interest rates. Cool. And then how it works, very simple. They purchase the assets, and purchasing assets means more money in the economy, which means increased reserves, essentially. So there's more money that the banks can keep on hand, which as a consequence, just like we spoke about, lowers the interest rate. And remember, when the interest rate is lower, you're going to think, not that bad. I can afford to take this loan because I can pay it back. So by encouraging lending and spending in that way, it also affects the price of things and also leads to inflation in majority of cases where it's been used, actually. So the advantages of quantitative easing is that it stimulates economic activity, like we already spoke about. It addresses deflationary pressures. So if there's deflation that's happening, then quantitative easing is what to implement because it's essentially it contributes to inflation, right? And remember, none of these things are bad in isolation. So long as they are used to maintain an equilibrium in the economy, that is important. Hyperinflation is where we start having an issue with it. Then it has the added advantage of supporting asset prices. So QE leads to the asset prices essentially increasing, right? And then it, like we already said, positive of increasing managing interest rates in the long term. It decreases them in the long term, I believe. Disadvantages are also really, really there. So there's the risk of creating an asset bubble, which is basically it can contribute to inflating asset prices, potentially leading to the formation of asset bubbles. This poses risks to financial stability, as the subsequent bursting bubbles could have a negative effect on the economy in its entirety. This is very similar to the discussion I've already had with you guys with respect to the inflationary effect that it has. Sometimes it's to an extent that is harmful. So it leads to an increase in the price of assets, which is another conversation about income inequality, because people who don't hold assets and wealth don't benefit from the system at all, and it just makes the rich richer sometimes. And if it's applied in the wrong conditions, it can be ineffective or it can have very little effectiveness. Here we can talk about the converse measure to quantitative easing, which is quantitative tightening. So as opposed to the government putting out, or as opposed to the Reserve Bank buying money. Well, no, that's weird. Not buying money. Sorry. As opposed to the Reserve Bank buying government back or government securities or mortgage-backed securities, in this case, it would sell them. So it would require private assets and private people to put money back into its system by selling these securities, right? So when it does this, it decreases the amount of monetary flow in the economy. And by decreasing that monetary flow, it combats factors that could lead to hyperinflation. All right. And then monetary policy. Let's finally discuss it. So monetary policy refers to the strategies that a country's central bank or the monetary authority uses to control and manage the money supply within the economy, right? We've already discussed this. So the primary objectives of monetary policy include price stability, and obviously creating better employment opportunities and creating more economic growth. So central banks use various tools and instruments to implement monetary policy. We've already spoken about a lot of these. There are two types of monetary policy. So there's expansionary monetary policy. With expansionary monetary policy, the objective is to stimulate economic growth and employment, particularly during economic downturns or recession. Sorry about the cars that you're hearing in the background or everything else that you might have heard. I don't know, whatever. But its main purpose is to inject more economic activity or to create more economic activity. What are the tools that we've spoken about that fall under expansionary monetary policy? Lowering interest rates. Because remember again, lowering an interest rate means that, or lowering the discount rate from the bank means that the bank is able to lower its interest rates, which means you're going to go, not bad, I can afford to take a loan. You taking a loan means you can buy from other businesses and money will just circulate better if the banks just lower their discount rates. Then open market policies, which we've already discussed, and then lowering the reserve requirements. So decreasing the amount of money that the bank needs to keep as reserves. When they decrease this amount of money, it allows them to do more lending because they have more money that's available to lend. That's expansionary monetary policy. Contractionary monetary policy, on the other hand, has the goal of curbing inflation and cooling down an overheating economy. So when the economy is doing too much, it intends to slow down the rate of it. So it does this through raising the interest rates. Because remember, when it's raising its discount rate, it's going to lend to you, or the banks, the commercial banks are going to lend to you at a higher interest rate, which means you're less likely to get a loan and you're more likely to save, which means that we're going to decrease the economic activity, which is necessary in inflation. Through open market policies, it's going to sell government securities. When it's selling government securities, that means that the private sector is going to be using its money to essentially give to the Reserve Bank, which will decrease the amount of money that will be in circulation, which is necessary when we get into a hyperinflation environment, because the rand or the currency becomes virtually useless because there's just too much of it. When we decrease its abundance, then we start increasing its value. Same chat why diamonds are so valuable, right? Because it's seen as something that's rare and precious. And then by raising the reserve requirement, again, we're decreasing the amount of money that's in circulation by keeping most of the money in the bank. This contracts the economy. That's contractionary monetary policy. Here are a couple examples of when expansionary monetary policy has been implemented. You can look into them. I think they're very simple, self-explanatory. I try to summarize them as well as I can. Here are more examples for you. Cool. And then let's talk about fiscal policy for a second. Now we're moving away from the, the Reserve Bank, and we're talking more about the government now. So fiscal policy refers to when the government or the use of the government spending and taxation to influence the economy. So think about it like this. Monetary policy is when the Reserve Bank is influencing the economy. Fiscal policy is when the government is influencing the economy. So it's one of the primary tools that the governments employ to achieve macroeconomic objectives such as economic growth, employment, price stability, and economic distribution. So fiscal policy can be expansionary or contractionary, depending on whether the government aims to stimulate economic activity or cool it down. We've already discussed essentially what this looks like. So here we're looking at what the government would do if it was doing expansionary or contractionary, fiscal policy. So if it was doing expansionary fiscal policy, it would increase government spending. So doing things like providing more public goods, infrastructure, stimulus packages, all of that stuff. If it wants to decrease, or yes, providing tax cuts as well so that there's more money in circulation. So if it wants to decrease or cool down the economy, it would use contractionary fiscal policy. This would include reducing the amount of government spending and, of course, increasing the amount of taxes. So they're like antagonistic, essentially, in how they operate. So, yeah. Then from there are some advantages to expansionary fiscal policy, which you can just breeze through here as well. You can read them. I don't think that they're very complicated. I think if you understand the system and how I explained it, you would very much understand the advantages and disadvantages of it with relative ease. Then there are the advantages and disadvantages of contractionary fiscal policy, same charts there in terms of the ease, in terms of how they operate. Then I gave some examples of where expansionary fiscal policy has been applied. So the United States used it both in COVID when they created the stimulus package and after the recession of 2007 to 2009. And it had some interesting ideas. Eurozone countries have also tried them. You can look at them. The reason why I'm putting these examples here is so that you guys have access to examples in the case where you encounter a debate where this is necessary, which is very likely. All right. Then there is the applications of expansionary fiscal policy. Again, I gave you the example of China and when they have used it. Yeah. So read through it as well, and I think it'll be simple to understand. I'm not going to waste any more of your time, so thank you very much for paying attention to this lecture, and I hope it's been beneficial to you. Please feel free to send me messages and ask me questions and everything in between. Cool. Have a great day, guys.